Welcome back to the deep dive. We crack open your source material, pull out the key insights so you stay informed. Today, we're tackling something most of us use almost daily, maybe without even thinking about it: the credit card. You know, it feels so modern, this little piece of plastic, or now just data on your phone, and global purchasing power in your pocket. But credit itself, that idea is ancient. So how did we get from, say, trusting your neighbor at the general store to this universal plastic in just, 70 years?
That's the journey, isn't it? Bridging that gap. Because you're right, the concept of buy now, pay later is incredibly old. I mean, our sources point to formalized laws about loans, interest, all the way back in the Code of Hammurabi. We're talking Mesopotamia, maybe 1800 BC. But for literally thousands of years, credit was, personal. It was local. Like you said, the 19th century store owner, they knew you. They knew your family. If they gave you credit, it was based on that local trust. The big drawback, though, that trust didn't travel at all.
Right. Completely non-portable. And that's the problem they had to solve. We saw some early stabs at it, like charge coins back in the late 1800s. And then that charga plate thing in 1928, that metal tag.
Yeah, the charga plate. It helped mechanize bookkeeping for specific stores, which was useful. But like the charge coins, it had that fundamental flaw. It was a closed loop. Your Macy's plate did you no good at Gimbel's down the street.
So it wasn't really about inventing credit.
Exactly. Credit existed. The real driver, the real need, was for interoperability. A way for strangers to transact, with some kind of trusted go-between guaranteeing the payment everywhere.
Okay, let's get into the story everyone thinks they know. Diners Club, 1950. The famous legend. Frank McNamara, businessman, dinner at Major's Cabin Grill in 49, forgets his wallet. Huge embarrassment. Bam. The idea for a universal card. The first supper, as some call it.
It's a fantastic story, isn't it? Almost too good to be true. And, well, turns out it mostly was. Matty Simmons, the very first employee they hired, later admitted the whole thing was basically a brilliant piece of PR. He actually said they glamorized the creation.
Whoa, wait. So the whole forgotten wallet thing, that was just marketing?
Pretty much.
Yeah.
Let's say a powerful exaggeration.
Yeah.
But think about it. Nobody knew what this thing was. That story. It instantly communicated the value. Forget your wallet. Embarrassed. This card solves that. Convenience. No cash needed. It was genius marketing, honestly.
Okay, so maybe the origin story was a bit embellished, but the business model itself was pretty solid, right? Even though it wasn't technically credit.
Right. Key difference. Diners Club was a charge card. You had to pay the balance in full every month.
Okay.
So less risk for them. They aimed it at wealthier folks, mostly for business travel and entertainment, T&E, And they made money two ways. Cardholders paid a fee, like an annual membership. Right. But the big money came from the merchants. They paid a pretty hefty fee, around 7% initially, on each transaction. 7%?
Wow. Why would merchants agree to that?
Well, for two main reasons. Guaranteed payment, which was huge back then, and access. Access to these high-spending, affluent customers walking through their door.
And it obviously worked. The growth was explosive, wasn't it?
Oh, incredibly fast. Started with McNamara's friends, maybe 200 people. By the end of 51, 42,000 members.
Wow.
And just 2 years later, 1953, he was already international.
Yeah.
UK, Canada, Cuba, Mexico. They proved the concept of a universal payment card was absolutely viable.
So Diners Club nails the convenience angle, but the real revolution, the thing that changed, everything about consumer finance, was adding lending to the mix, revolving credit, which brings us to the chaos. The Fresno drop, September 1958.
Exactly. Bank of America, they saw Diners Club, but they weren't content with just convenience fees. They wanted into the lending game. Their Bank of America card, which eventually became Visa, introduced the truly transformative piece, revolving credit.
Why was that the game changer? Allowing people to carry a balance?
Because it completely altered the public's relationship with debt. Diners Club was disciplined, paid off monthly. Revolving credit, you could carry that balance month after month, just pay interest. Suddenly, the card wasn't just a tool for rich business guys. It was a way for ordinary people to access loans, to buy things they couldn't afford outright. It effectively democratized debt, for better or worse.
But that initial rollout in Fresno, it was a complete disaster.
Oh, an absolute unmitigated disaster. A legendary one in banking history. Bofford just mass-mailed 60,000 active, pre-approved Bank of America cards.
To whom? Did they vet anyone?
Nope. Just mailed them out across Fresno and the Central Valley. to households they knew almost nothing about. No applications, no credit checks beforehand, just here's a live credit line.
That sounds insane. The fraud must have started instantly.
Instantly and everywhere. They had zero systems in place to handle this kind of unsecured revolving risk. Fraud was rampant. People who shouldn't have gotten credit got it. People used cards that weren't theirs. And the delinquency rate, it hit 22%.
That's 22. What's normal for loans?
At the time, maybe 4 or 5% for their other loan types. So 5 times higher. It was catastrophic.
The losses must have been eye-watering.
They were. In that first year, they lost $8.8 million directly. Add in overhead and startup costs, it was closer to $20 million. A huge amount of money back then.
But here's the fascinating twist, right? That absolute mess, that expensive failure, was actually the catalyst for building the modern credit industry.
It really was. It was the ultimate, very expensive learn by doing. That chaos forced Bank of America to invent, practically overnight, the systems we still use. Formal credit scoring models, sophisticated fraud detection algorithms, dedicated collections departments. They had to build it all fast just to survive the crisis they'd created.
So they proved the model could work, but only after nearly bankrupting themselves figuring out how to manage the risk.
Exactly. And the whole unsolicited card mailing fiasco, it continued, causing problems across the industry until Congress finally stepped in and banned mailing active cards in 1970.
Okay, so BOFA survives the Fresno fire. They've got this powerful product, the Bank Americard, but then they hit another wall. Federal banking laws. They couldn't operate nationwide themselves.
Right. Interstate banking restrictions. So their only option was to license the Bank Americard system to other banks across the country.
But these banks were all competitors, right? Fierce rivals.
Fierce rivals. And none of them liked the idea of using a system ultimately controlled by Bank of America, their biggest competitor. The licensing arrangements started getting really messy, really hostile. The whole thing nearly fell apart.
How do you get arch enemies to cooperate on the infrastructure, the plumbing, while still letting them beat each other up on the actual products?
That was the million-dollar question. And the answer came from this mid-level BOFA VP nobody had really heard of named Dee Hock. He had this radical idea. He called it a chaordic organization.
Chaordic, like chaos and order.
Exactly. A blend of the two. His vision was a non-stock, member-owned corporation, a neutral utility. The member banks, BOFA included, but just as one member would collectively own and govern the network itself. The rules, the standards, the pipes. This meant no single bank controlled it. They could all trust the infrastructure because they all owned it, and they could go out and compete like crazy, issuing their own branded Bank Americards with different fees, different features.
Brilliant. Cooperation on the basics, competition on the rest.
It was the key. This structure allowed the network to survive and thrive.
And that led to NBI, National Bank Americard, incorporated in 1970.
Right. And then, crucially, in 1976, they realized the Bank Americard name was still too tied to BOFA. They needed something neutral, global, easy to say everywhere.
Visa.
Visa. Short, memorable, sounds the same in most languages. Perfect global brand.
And the competition wasn't sitting still either, right? There was another group of banks.
Yep. A rival alliance formed the Interbank Card Association, or ICA, back in '66. They launched MasterCharge in 1969. And following the same logic as Visa, looking for that global appeal, they rebranded in 1979. MasterCard. And just like that, you had the global duopoly basically cemented, Visa and MasterCard controlling the rails.
But all this growth, especially after the Fresno drop kind of exposed the dangers, it needed guardrails. Regulation had to catch up.
Absolutely. The industry couldn't sustain itself without public trust, and the early days were, frankly, a bit of a Wild West. 2 pieces of legislation were really fundamental. First, the Truth in Lending Act, TILA, passed in 1968.
TILA, what was the big deal there? Standard disclosures.
Standardized disclosure. Seems simple, but it was revolutionary. Before TILA, lenders could calculate interest and fees in all sorts of confusing ways. It was impossible to compare offers. TILA forced them to use a standard format, clearly stating the costs, especially the annual percentage rate, the APR. Suddenly, you, the consumer, could actually comparison shop for credit. It empowered people.
Okay, that makes sense. And the second big one?
The Fair Credit Billing Act, FCBA, in 1974. This did a couple of important things. It set up formal procedures for fixing billing errors, which was needed. But the absolute masterstroke, the thing that probably did more than anything else to make people comfortable using cards, was capping your liability.
The $50 limit.
The $50 limit. If your card was lost or stolen, the most you could legally be on the hook for was $50. period.
That's huge. Psychologically, that takes almost all the risk away from the consumer.
Exactly. It transferred the risk to the banks and the networks, incentivizing them to build better security. But for the public, it made the card feel safe. Risk-free convenience. Massive boost to adoption.
So with trust established by law, the focus shifts. The next big battle is technology versus the fraudsters. And the first major tech upgrade was that stripe on the back.
Magnetic stripe, yeah. Developed by IBM, rolled out around 1969. There's this story, maybe apocryphal, about an engineer's wife suggesting ironing magnetic tape onto a card. Who knows if it's true?
Maybe. But it worked.
It worked. It allowed card data to be stored electronically, read by a machine. This enabled electronic authorization, point-of-sale terminals, much faster, more efficient transactions than the old paper imprinters. A huge leap.
But it wasn't perfect, was it? There was a fundamental weakness.
A fatal flaw, really. The data on the mag stripe, it was static. It never changed. Your account number, expiration date, it was all just sitting there.
Which means?
Which means it was incredibly easy to copy. Criminals developed skimmers devices that could read and steal the data off the stripe in seconds, maybe a dodgy gas pump or a restaurant terminal.
And then they could just make fake cards.
Exactly. They could clone your card perfectly. This led to a massive global epidemic of counterfeit card fraud. It cost billions. The mag stripe's convenience came at the cost of terrible security.
So the industry needed a fix, which led to the chip.
The EMV chip, developed initially in Europe back in the 1990s. EMV stands for Europay, MasterCard, and Visa, the companies that developed the standard.
How does the chip beat the skimmers?
It fundamentally changes the nature of the data. The chip is essentially a tiny computer. Instead of static data, it uses dynamic data. For every single transaction, the chip performs a cryptographic calculation and generates a unique one-time use code, sometimes called a cryptogram.
One-time use?
Right. So even if a fraudster somehow intercepts that code during a transaction, it's useless. They can't use it to make another purchase or clone the card because that specific code is only valid for that single specific transaction. It breaks the counterfeit model.
Makes sense. But the US was really slow to adopt the chip, wasn't it? We stuck with mag stripes for years after Europe switched. Why the delay?
Cost, mainly. Upgrading every single payment terminal in the country, millions of them, plus all the cards. Yeah, it was a massive expense. Merchants and banks basically played chicken, either wanting to foot the bill first.
So what finally broke the logjam?
Pure financial pain. The networks Visa and MasterCard imposed the liability shift in October 2015.
Liability shift. What did that mean, practically?
It basically said, from this date forward, whichever party in a transaction is using the older, less secure technology, the mag stripe instead of the chip will be held financially responsible for any counterfeit fraud that occurs.
So if a bank issued a chip card, but the merchant only had an old mag stripe reader, the merchant ate the loss, and vice versa.
Precisely. Suddenly, there was a huge financial incentive for everyone to upgrade. Banks started issuing chip cards rapidly, and merchants scrambled to install chip reading terminals.
And did it work? Did fraud go down?
Dramatically. Visa reported, within just 3 years of that liability shift, an 80% drop in counterfeit fraud losses at U.S. merchants who had enabled chip readers. 80%. It absolutely worked.
Okay, so the chip largely solves the problem of counterfeit cards used in person, but criminals adapt, right? Where did the fraud migrate?
Online. Card not present or CNP fraud. If you can't easily clone a physical card anymore, you focus on stealing card numbers and using them for online purchases where no physical card is required.
Which leads us to the next phase. The card starts to disappear, it becomes less physical.
Exactly. The focus shifts to securing digital transactions, and interestingly, the card itself begins to dematerialize. This is where mobile wallets come, in Google Wallet first in 2011, then Apple Pay, really pushing it mainstream in 2014.
How do mobile wallets improve security for online or tapped payments?
They rely heavily on a technology called tokenization. It sounds complex, but the idea is simple. When you load your card into Apple Pay or Google Wallet, your actual 16-digit card number isn't stored on the phone or transmitted during the transaction.
Okay, so what is?
Instead, it's replaced by a unique digital token, a substitute number that's specific to that device and useless to hackers if stolen. Plus, you often still get the dynamic cryptogram, like with the chip. So it's multiple layers of security.
Got it. And we're also seeing things like virtual cards more often now.
Absolutely. Yeah. Temporary or single-use card numbers you can generate just for online shopping. Our sources say something like 42% of U.S. consumers have used them. It limits your exposure if a merchant database gets breached.
So with the actual payment process becoming safer and more of a commodity, what are the card companies competing on now?
Loyalty, pure and simple. It's all about rewards, points, miles, cash back. The underlying payment network works reliably now. The security is much better. So how do you get someone to choose your card and use it often? Rewards programs.
And people really respond to that.
Oh, definitely. The data shows it. For something like 43% of consumers, the rewards program is the #1 reason they choose a particular credit card. It's powerful behavioral economics in action.
But there's a hidden side to all those rewards, isn't there? A kind of redistribution.
Yes. This is something most people don't think about, but it's significant. There's a massive cross-subsidy built into the system. A Federal Reserve study from just last year, 2023, estimated that about $15 billion annually is effectively transferred.
Transferred from who to who?
From less affluent consumers, those who tend to carry balances month to month and pay significant interest charges and late fees, to more affluent consumers, the ones who pay their balance off in full every month and strategically maximize their points, miles, and cash back.
Wow. So the people racking up free flights and hotel stays are essentially being subsidized by people who are often struggling with debt.
That's the uncomfortable economic reality of the rewards ecosystem, yes. The interest and fees paid by one group fund the rewards collected by another.
That puts a different spin on those glossy reward offers.
It certainly does. And it also highlights why co-branded cards, the airline cards, hotel cards, store cards, are so valuable to companies. They're not just about the rewards, they lock in brand loyalty. And crucially, they provide the bank and the partner company with incredibly detailed data about your spending habits. That data itself is extremely valuable.
Okay, what a journey. Let's quickly recap. We went from ancient systems of personal trust.
Right, through clumsy early attempts like the chaordic plate.
Uncovered the marketing genius, maybe deception, behind the Diners Club origin story.
Witnessed the absolute chaos and necessary innovation born from the Fresno drop and revolving credit.
Saw how rivals learned to cooperate through Visa and MasterCard, built on Dee Hock's chaordic idea.
How essential regulations like TILA, and especially that $50 liability cap, built the trust needed for mass adoption.
And then traced that tech arms race, the vulnerable mag stripe, giving way to the secure EMV chip,
which shifted fraud online, driving tokenization and the dematerialization of the card itself.
So where does it go from here? What's the next frontier?
Well, the trend seems to be towards invisible payments, making the transaction itself disappear frictionlessly into the background. Biometrics are a huge part of that. Moving security away from something you have, a card or something a PI, to something your fingerprint, your face, maybe even your voice print. And AI is playing an increasingly large role, not just spotting fraud in real time, but potentially acting as a hyper-personalized financial advisor, analyzing your spending, offering savings advice right within your banking app.
Okay, so that leads to a final thought for you, our listener, to chew on. As we move towards this future of invisible biometric payments, if the card truly vanishes, if your body becomes your credential, the nature of security changes fundamentally. So ask yourself, are you more comfortable safeguarding financial details, account numbers, passwords, things that, if compromised, can ultimately be changed or reset? Or are you more comfortable protecting the absolute integrity of your unique, unchangeable biological data? Something to think about next time you tap, or maybe soon, just glance, to pay.